Howdy everybody, I'm Gary and this is GLoPersonalFinance, where I talk about getting your finances under control, building wealth, and becoming financially independent. Loans sometimes are an inevitable part of life. You don't have the cash on hand to buy something, so you gotta borrow this money. This isn't necessarily a bad thing if you know you can leverage this debt and use it to make more money for yourself, like buying a house or going to school. You can use a loan to benefit you. So let's learn the basics of what a loan is, what interest means on the loan, and an amortization schedule, and how to manage loan debt. I'll be giving you a quick example on school loans and how to pay for it after you graduate. So let's get started. So since I'm paying for higher education as my example, if you need money for college, you first need to go sign up for FAFSA. Do not pay anybody to help you with your FAFSA. Just go to fafsa.ed.gov and sign up for yourself. You need a few documents to see if you qualify for a government-backed loan. FAFSA is a first-come, first-served type of situation with a few more underlying metrics, so if you need a loan, sign up on January 1st. You'll need a few documents: bank statement, W-2, Social Security, and federal tax returns. So get those ready. So you have a few types of loans out there if you've got approved for financial aid. You have something called a Stafford loan. This type of loan can be subsidized or unsubsidized. Stafford subsidized means if you borrowed $5,000 for school, your interest is paid for by the government the whole time you're in school, plus 6 months after you graduate. So 6 months after you graduate, when you start paying off your loan, it's going to be that $5,000. However, a Stafford unsubsidized means if you borrowed $5,000 for school, your interest is stacked year upon year while you're in school. And when you start paying off your loan 6 months after you graduate, with that average interest of 5% over 4.5 years, your starting loan payoff would be $6,227.62. But what? I only borrowed $5,000, but now I have to start paying off $6,200? Yes, you do. Because interest sucks. So yeah, if you're able to get a subsidized loan, you get a better deal. So yay! You and your kid have graduated college, and if you're the average college student, you have accumulated around $28,000 worth of debt with an average interest rate of around 5%. Most undergrad student loans have terms where you pay off your loan over 10 years. So we'll use this as an example. There are two-ish parts to a loan: the principal, the amount that you borrowed, and the interest, the percent the bank charges you over time. So let's run through this scenario. So congrats, you got your diploma, and the first thing you do is pay off your loan to the lender. You cut them a check for $28,000 and you'll be free and clear of that 5% interest, because that 5% interest has no time to take hold of your loan. But if you're like any other recent college graduate, you are dirt poor. So you're going to be making payments over 10 years. Therefore, you'll be making a total of 120 monthly payments. Each of those payments will be around $297. So now I'm going to wait while you do this multiplication yourself. 297 times 120 payments. You should have gotten a total of $35,640. $35,640. Yeah, I know, you only borrowed $28,000, but over the life of the loan, over 10 years, that interest keeps on creeping up and stack upon itself. So not only are you paying back the principal, or what you borrowed, you're paying back that interest over 10 years. So let's break it down. That $297 monthly payment you're making, after your first month of payment, you've only paid $180 off your principal and paid $117 in interest. Even though you paid almost $300, your principal has only dropped $180. Which means you still have $27,820 left to pay. That $117 in interest is practically flushing money down the toilet, never be seen again. Now, according to the amortization schedule, you're not paying this $180 principal and $117 interest every month. As time goes on, you start paying more and more in principal and less in interest. But the fact still remains. On the $28,000 loan with 5% interest, you'll be paying an additional $7,640 just in interest. But you can take charge of your loans. Let's say you upped your payment an extra $50 to $347 per month. That extra $50 goes directly to your principal, so that interest will no longer have that effect on that money. With that extra $50 going directly to the principal, you'll pay off your loan in 1 year, 9 months early. And you would have saved an additional $1,400 worth of interest. There is one thing I recommend all people to do before taking on a loan. Any loan, a car loan, student loan, credit card loan, you must find out and learn how to make or read an amortization schedule. So many people just look at the monthly payment and leave it at that. However, you need an intimate understanding not only on your monthly payment, but what part of your monthly payment is paying off your principal and what part is paying off interest. The knowledge of how a loan works will only benefit you in being able to leverage this debt and know how to conquer it. There are many ways of paying off debt. There's the snowball method, there's the avalanche method. However, if there's one thing you should never do is miss a payment. That will ding your credit score quite significantly. For me, I always try to pay more than my monthly payment. If I recycle some cans, I throw that money into my loan. I didn't buy Starbucks and made some coffee at home, I throw that extra money onto my loan. I do whatever it takes so that interest doesn't grab hold of the principal and take advantage of it. Hopefully you found this information very helpful. Loans can help you, but it could also bury you. Take charge of your loans. Don't let it take charge of you. Please consider liking and subscribing to my channel. Browse my other videos on how to build wealth. Check out the links in the description for other ways that I build wealth. I'll see y'all later.